we're headed toward massive money printing to keep these yields down. Because if you're going to accept 3% inflation now, what do you think happens 2026, 27, 28, if we don't have a recession, if we don't get that reversion and the stock market crashes, or even if it does crash, we're still going to get the money printing. So it doesn't, there's no way around it. It's not that, again, it's not that the officials, the central banks, it's not that the Fed, the Treasury have learned their lesson.
That is why I expect that the risk-off asset, gold, to continue outperforming the risk-on assets led by cryptos for a long period. At some point, when we get those risk-on assets to correct, Treasury bonds will kick in. You'll have that rally that's way overdue. Some of us have been wrong for too long. And then at some point, it'll be time to buy when the dust settles. And right now, all those indications are right there. If we get through the next 3 months, McGlone might get stopped up. But gold being up 48.2% on the year and Bitcoin's only 20%, yet Bitcoin trades 2 to 3 times the volatility, is a poor performing asset.
The global financial system is once again approaching a crossroads where policy choices, market dynamics, and structural imbalances converge to shape the next cycle. Rising debt levels, persistent inflation above target, and the growing strain on government bond markets are forcing central banks into unprecedented territory. The concept of a third mandate for the Federal Reserve, maintaining long-term bond yields at a controlled level, has begun to gain traction, signaling a shift toward yield curve control. This effectively means sustained money printing, not because policymakers want it, but because the system demands it. Accepting 3% inflation today sets the stage for higher inflation later, and the burden of stabilizing markets will fall on a Fed trapped by its own policies. Against this backdrop, gold continues to emerge as the outperforming risk-off asset, while cryptocurrencies struggle under their own volatility and lack of foundation. MikeMcGlone, a seasoned macro strategist at Bloomberg Intelligence, has long warned of gold's structural advantage in this environment, highlighting its resilience amid policy excesses. JamesLavish, a former hedge fund manager, highlights the systemic trap that central banks face, with fiscal dominance compelling monetary authorities to absorb debt and suppress yields. Together, their insights draw a clear line between assets built on fundamentals and those driven by speculation. Navigating this shift requires clarity, patience, and an eye on tangible assets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
In futures, there's about 16 million equivalent of longs in gold. That's the COMEX futures. Last year, the peak was around 25 million, so they've been selling off. ETFs are just starting to kick in, but they're just following that gold rally. They're lagging way behind, certainly if you look trends since 2008. So who's buying? Some maybe central banks, but it's not showing any of those kind of tilts you usually see that shows an overbought market. So first I'll start with gold. 3,500 is very good support. That was old resistance. 4,000 is good resistance. It's unlikely to trade much higher from here without the stock market giving it fuel by going down. And to me, the macro is the best indication for all that is cryptos, and they're just starting to give back a little bit. Right now, it's just nothing. It's just going back to 100,000 Bitcoin's nothing. But then I point out some of the things that have been happening all year. Bitcoin and cryptos have been way underperforming gold. Risk-adjusted basis way underperforming, and I'll tilt over something that to fire up James a little bit. Now we got that 20-plus year index in the U.S. bond index. It's up 5% on the year, and it's just starting to kick in, I think.
Well, one of the things, though, Mike, is we got to pull apart is back in the 70s and early 80s was the reason for inflation was what you said, the Iranian Revolution. We had a serious drawdown on the availability of oil in this country. And so energy was way expensive, which is the main component of pretty much everything, right? So it's different this cycle. It's not different this time. It's different this cycle in that the reason for inflation is because we printed $5 trillion in 2021.
99% of the cryptos have no basis. Now, Crypto dollars do. I'm very bullish crypto dollars, 300 billion or so. I think that's going to go up. Maybe some of them do, like gold, but the other 99% have no basis. At some point, they're going to go poof. And I want to show you a few screen. I think the poof has started. Yes, I've been early. Gold's going to give that signal. First, a short little signal. MicroStrategy, the leading indicator of this oxymoron of Treasury and Bitcoin in one sentence, is rolled over. The 200-day moving average is rolled over. It bumped up there Friday, and obviously it's going to be much lower by the open this morning. And one thing is U.S. Treasury bond yield. So this is the pinnacle of risk assets, MicroStrategy. And the absolute opposite is U.S. Treasury long bond. I say this because that's why I started in the trading pits in the 80s. I thought I knew that market better than ever, and I've been wrong about this downward trend, but it looks like it's trending back upwards, particularly if cryptos go down. I just want to show you a few little things. This is just my normal little chart. This is a little trade, and then you get to the big picture. Yeah, Bitcoin and VIX. VIX just goes back to 20. Bitcoin goes back to 100,000. End of the year, it's a trade. No big deal. Here's a macro big picture thing. That's something that's never happened. We have U.S. stock market cap to GDP, the highest ever, going back, in this case, I'm only going back 50 years. The highest ever, 2.3 times. But then you take gold divided by the Treasury bond, and the Treasury index. I was finally able to go back about 50 years. I have to go back to 1983, how cheap Treasuries are. And then I just show one thing that's pumped me up recently. We've seen Dogecoin jump up to 43 billion. I think that's going to lose a zero. I mean, to me, that's shorts trying to get going there. And then I just look at my old Bitcoin gold cross. It's just breaking down. It's going to go back to 25. Not a big deal. It failed at 36. Just what commodities do. This is a classic commodity. It gets people bullish at the upper end of the range, gets them bearish at the other range, and they just trade the range. But the key thing I want to end with is this is the key thing for everything. You have to, if you're bullish, any type of crypto right now, most notably Bitcoin, you have to expect the U.S. stock market to keep appreciating. Yet on a normal backup, this is 2.3 times GDP. It goes down to back 1.75. That's been a pivot for.
One of the things, we talk about the 10-year, the long bond, all that, but one of the things that's happening in the 10-year is that we've now heard that the Fed is considering basically a third mandate. Third mandate is to keep a lid on long-term bond yields.
Mm-hmm.
And so that's keeping a lid on the 10-year, the 20-year, and the 30-year on those yields. So that's a structural, another structural issue that has not been there before. We're talking about yield curve control on the U.S. Treasury, which goes to your point, Mike, which you've said a long time. We've all been saying that we're all turning Japanese. We're headed toward massive money printing to keep these yields down. Because if you're going to accept 3% inflation now, what do you think happens 2026, 27, 28, if we don't have a recession, if we don't get that reversion and the stock market crashes, or even if it does crash, we're still going to get the money printing. So it doesn't. There's no way around it. It's not that. Again, it's not that the officials, the central banks, it's not that the Fed, the Treasury have learned their lesson. It's that they are absolutely trapped by the math of the situation, and they know it, and that's why they're kind of whispering this out. Hey, you know what? We're close enough to 2% inflation. We're nowhere near 2% inflation. We're 50% higher than 2% inflation. Number one.
True.
Number two, yeah, we're buying back bonds because they're illiquid. You're buying back bonds to keep lids on yields for illiquid securities. Like that's yield curve control, And then when you start leaking that, we're going to make sure that we manage the yields of the longer treasuries. Again, that just points to further money printing. So I don't know. I don't know exactly where the stock market goes. Nobody does, if we have a black swan event or not. But all things being equal here, unless we grind into a recession, there's a reason the 10 years where it is.
That is why I expect that the risk-off asset gold to continue outperforming the risk-on assets led by cryptos for a long period. At some point, when we get those risk-on assets to correct, Treasury bonds will kick in, You'll have that rally that's way overdue. Some of us have been wrong for too long. And then at some point, it'll be time to buy when the dust settles. And right now, all those indications are right there. If we get through the next 3 months, McGlone might get stopped up. But gold being up 48.2% on the year and Bitcoin's only 20%, yet Bitcoin trades 2 to 3 times the volatility, is a poor performing asset.
The debate over the Fed's path highlights just how fragile the current environment has become. On one side, there's the argument that incoming data, particularly revisions to payrolls and sticky inflation readings, will justify fewer cuts than markets expect. On the other hand, bond and futures markets are already pricing in a meaningful easing cycle, with expectations that policy rates will be down near 3% by next year. This disconnect reflects a more profound concern, that policymakers are boxed in by their own past actions. Having normalized inflation closer to 3%, rather than the 2% target, they're now walking a fine line between preventing a slowdown and acknowledging structural inflation pressures. At the same time, corporate credit markets are flashing signals that are often overlooked. Historically, rate hikes have coincided with spreads blowing out, yet this cycle has been cushioned by the liquidity unleashed from massive fiscal and monetary interventions. The $5 trillion in stimulus continues to distort market behavior, funneling capital into narrow pockets, such as mega-cap equities. As policy shifts again toward easing, the historical playbook suggests gold gains, while equities face greater downside risk. Let's get back to the interview.
Anna Wong, our chief economist, said the Fed's reaction functions obviously switched to more dovish. He thinks that FOMC is penciling another 25 basis points cuts this year, expecting strong spending retail sales, 0.5% monthly pace of consumption growth, personal income 0.3%. So her quote was, "How do you square that?" She's expecting July and August non-farm payrolls to revise back up, which I thought was quite a profound statement. Personal income growing faster. Friday's report will show 0.3%. She's expecting coming months CPI will be hot. Used car models, auto dealers passing through higher costs. The baseline for the Fed is to cut only 50 basis points for this year. That's her view. Skip the OC meeting and go another 25 in December. That's her view. Switching over to Chris Kane, our more quantitative focused equity analyst. This is not much to not like in stocks. He's calling it the small cap jailbreak. Small caps breaking out. His quote was, "Our size are overbought, but that's what's supposed to happen in bull markets." His point was, stocks usually do well if inflation is 3% or lower, certainly if there's strong growth. And it's unusual for cutting cycles since all-time highs. It's usually good for markets. And then he pointed out the exception of 2007, which is one of those things that I like to point out. Sure, if you expect when it goes down, it's okay. But those of us who did well in those periods. Ira Jersey, his yield curve focus remains still on the steepener, the steepening curve bias. He pointed out supply recently has been taken down very well. She points out lots of dollar bearishness has been priced in. She's been very bearish on the dollar. She's been top of that, and it seems like she's pulling back a little. She's not jumping onto the dollar's bearish next anymore. And her fear is gold just keeps pushing higher. So
let me ask you something, Mike. So let's go back to Anna Wong, and I do appreciate her work. I think she's very smart, obviously. But Mike or Scott, I just pulled up the Bloomberg Fed futures to show that. Okay, so let's just pull this apart. So Anna says that they skipped this cut, which the market is giving a 91% chance that there's going to be a 25 basis point cut in October. She says they skip that and only do one in December, which they're giving an 87% chance on that meeting alone on top of this one. So she thinks that job numbers are going to be revised upwards for last month rather than our typical downward revision. So, and that's why, right? Because we're looking at Friday, we've got the PCE numbers. And so she thinks that this PCE number comes in at 0.3. Is that what I heard you say?
Yeah.
So all things being equal, the reason that she thinks we skip the October cut is because the job market firms up in the eyes of the Fed and because they're data dependent. Is that fair?
Yeah, I would agree with that.
Okay. I mean, she's done a lot more work on the jobs numbers than I do. But again, our issue with the jobs numbers have been continuously over and over and over and over again, which she admits, and I've actually exchanged with her on X about, is that we have a problem with the birth death model. Changes for the positive for the recent numbers, but it's just hard for me to get there. I don't know how she's getting there. I wish I did, but that's interesting. Fed worried about exactly what Scott said, stagflation, and they're kind of towing the line here. They're like, we are seeing some evidence that there's not been as strong of a job growth, as we thought. Well, maybe that's because 900,000 jobs were revised out of the numbers last year. That may be the reason.
Whatever.
But
900.
the other reason is that they keep saying they're data dependent and working for the American people. You heard him say that 3 times in that presser. Am I right? I felt like he said it more than that, but I heard at least 2. I think it was 3 times. He said, we're working for the American people. Well, they're in a really tight spot here because they understand that they're normalizing inflation up here at these rates. And so if Anna's right, then they did the right thing by cutting 25 basis points and stepping back. Let's see, but I mean, this morning, Bostic is saying that he doesn't see any reason to cut rates again. We should just hold steady here. So, I guess all things being equal, we're expecting inflation to continue to stay here at the rate to stay here at around 3% or rise slightly, and for the employment market to stabilize. I mean, nobody knows what full employment is, but we know we have more unemployment than we did last year. That's what we know.
I think you did a great job of lining up what Trump is setting up for his plausible deniability. When this happens, because to get through 4 years of Trump administration without a 20% correction in the stock market that stays down will be just as unlikely as obviously here's my indications for it. Gold, waning cryptocurrency performance, waning performance of the Bloomberg total of the total return, the S&P 500 since 1997. And I want to show you one chart that I think just kicked in. So the Fed just started easing, and we're going to be, and based on Fed funds futures, if you can show, looks like it came back, we're going to be at 3% Fed funds this time next year. It's going to happen. Questions, are we going to be lower? Or going to be higher? But on that same scale, and this is Fed just started easing, on the same scale, I just played around with it. I just played S&P 500 turns of ounces of gold. The Fed starts easing in 2001. Some of us remember that well. And you want to be long gold, short S&P 500. Takes down. Fed starts easing September 2007. Some of us remember well. Stock market made a new high a week or 2 later, and you want to be short that and long gold. Same thing. They start easing 2019. You want to be long gold, short the S&P 500. Is it different this time? The gold S&P 500. S&P 500 turn of ounces of gold has broken down through its enduring pivot since 2006. I'm going with the trade. Stop me out. Make the market stop me out. Bitcoins continue to go higher, that might be a stop out. If we just continue, I'm afraid now as we head towards fourth quarter, this whole little thing might accelerate.
Right here, this is the corporate spreads. Okay, this is corporate spreads to the 10-year, meaning if this is going up, that means that spreads are going wider and that there's more, that you're being compensated, investors are being compensated for the risk of those corporate treasuries, right? When you see the Fed funds down here is the blue line, the upper bound rate. Fed funds raises rate, the Fed raises rates, corporate spreads blow out. Fed raises rates, corporate spreads blow out. Raises rates, blow out. Raises rates, they've been continually consolidating, coming down. What do you make of that? And I have an idea of what I think is going on.
And in beginning 2000, and corporate rates spreads peaked when Fed funds were bearing on the way down. Again, in 2008 or so, they peaked right about the time when Fed funds went to zero.
Wouldn't you argue? Do you think there's no correlation between Fed raising rates and the corporate spreads blowing out.
My point is corporate spreads are so narrow now. There's only one little room for them.
Yeah, exactly.
To go up, and Fed's cutting rates to help because they know what potentially might be happening. Like they started in 2000 and then in 2007 is that tilt towards a recession that hasn't happened for 2 years, and they're just trying to be ahead of that game. And I think the bottom line is what they should be talking about. Really, what matters, the elephant in the room, is that the stock market has to go up. If it goes down, then there's your recession. There's your corporate rates blown out. It's just a matter of time. I mean, come on, they're narrowest in how long? Is that 25 years?
Fed funds goes up, spreads blow out, market gets crushed. Up, blowout, market gets crushed. Right here. This is the $5 trillion that was printed. That's what's going on here. It's looking for pockets of return. It's looking for pockets of return in corporates. It's looking for pockets of return in those 7 stocks in the S&P.
Yep. If you did that versus
that's my point, and it continues
that versus the equal weighted
rise, and these continue to go lower as the Fed just keeps rates here.
As we step back and look at the broader picture, the theme that keeps surfacing is fragility masked by short-term optimism. Markets may appear calm on the surface, but underneath, the cross-currents of monetary policy, fiscal maneuvering, and speculative flows create an environment that can shift rapidly. Gold, silver, and the miners are reflecting this dynamic, moving in ways that seem rational given the backdrop, but also carrying the type of volatility that can turn without warning. This is what makes the current cycle different from prior ones. The speculative capital is not concentrated in one place, but spread across assets, rotating with surprising speed. Tariffs, subsidies, and political pressures are reshaping how markets price risk. For investors, that means the old playbook of watching the Fed exclusively is no longer sufficient. The next few years are likely to bring a more complex mix of policy shocks and capital rotations, with some areas benefiting significantly while others struggle. For those paying attention, this isn't just about surviving volatility, it's about positioning early, recognizing where the crowd is late and where real value remains underappreciated. The opportunities are there, but so are the risks. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.